Today in InvestTalk, we look at what the Fed rate cut will mean for inflation and asset markets. Then we discuss today's market moves. We also answer questions about gold, Uber, Planet Fitness, and more. And at the end, I discuss the impact of office vacancies on the financial system.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point is about the Fed's rate cut and whether it will start to reignite inflation fears and what will happen with other asset classes like stocks, bonds, the dollar, etc. And the main factor to consider here is the broader economy. Like, it's not a lot of people will act like, oh, the Fed's cutting rates and that is a problem, or it's not a problem, and that it's going to solve everything. And the reality is nobody really knows, but you can continue to monitor the broader economy to see what side we end up on. You know, do we successfully execute a soft landing, or is it something that, you know, the Fed has already been tight for too long and creates a hard landing? Now, the markets are pricing in about 250 basis points of easing by the end of next year. Now, we've already seen 50 basis points, so basically another 50 by year end, and then another 150 through next year to bring us down to around the 2.5% level, 3% level on the Fed funds rate. Now, on average, the S&P has slumped 4% in the 6 months following the first rate reduction if the economy was in a recession. That compares to a 14% gain for the S&P 500 when the Fed cut in non-recessionary periods, okay? So what are we now? Well, Fed GDP now number has us at the high twos for economic growth. That's not a recession. That's fine. Now, obviously, that can change because the National Bureau of Economic Research is the one that classifies whether we were in a recession or not in hindsight. And once again, little evidence right now says that we are currently experiencing one. So you have to say, well, this is actually relatively bullish for stocks. And unless corporate profits really take a nosedive, this is probably, odds are better that we will be in a soft landing, especially when you layer on the amount of government spending we've had over the past 3-4 years and what that has done to the average corporate and consumer balance sheet, which is consumers have strong balance sheets. They have locked in 3% mortgages with low overhead costs. They've gotten raises because of inflation. They paid down debt with a lot of those PPP loans and checks that were sent out, et cetera. Yes, there are pockets of weakness, absolutely. But in general, you have to say, odds I think are higher that this will be a soft landing. Now, the S&P 500 was down on average nearly 12% 1 year after the initial cut that took place during recession. Okay, so down 12% in 1 year and down 4% in the 6 months after. Now, that compares to an average of a gain of 13% following cuts that came in those non-recessionary periods. Once again, that were to normalize policy. And, you know, the Fed has been kind of talking about that. Normalizing policy, getting back to neutral as opposed to restrictive. Now, overall, the S&P 500 has been 6.6% higher 1 year after the first rate cut of the cycle. And that's since 1970. Okay. Now, what sectors did the best? Consumer staples, consumer discretionary. They had the best average performance, rising about 14% 1 year after the Fed rate cuts. Healthcare rose about 12%. Technology gained about 8%. And small caps did even better, up about 7.4% versus that 6.6% for the S&P. So consumer staples, consumer discretionary, and mid and small caps are probably going to be the better place to be in the equity realm. Now, what about bonds? Treasury yields tend to fall alongside with rates when the Fed eases monetary policy. The Bloomberg U.S. Treasury Index returned 6.9% on a median basis 12 months after the first rate cut. But in a soft landing scenario, only 2.3%. Okay. Remember, that's including the yield. So if you get a soft landing, what are treasuries yielding now? Depending on, if you're talking about 10-year, 30-year, short term, we're kind of in that 3.5% to 5% range, depending on the duration. But let's call it 4%. And, so that means that, you could actually see bonds fall by 1% to 2% over the next year on average. And it shows you that a lot of those gains in the bond market have kind of been backloaded. And then what happens to the dollar? Well, the dollar tends to strengthen about 7.7%. That's the median gain a year after the first rate cut when the economy is not in a recession. So the strength of that economy kind of counterbalances the rate cuts, and means those rate cuts actually start to get priced out of the market because we're not in a recession, and therefore the dollar tends to strengthen. So I think a mixed bag on the dollar front, and we'll kind of see where that goes. But that's kind of what to expect now that we are in that rate cutting cycle. Now let's take a look at the market today. It was a modest update, about 0.25% up on the S&P, about 14 basis points on the NASDAQ. Dow, similar, about 15 basis points. The broad U.S. market was up about 29 basis points there. So it was a modest update, but definitely some hesitation at these new highs. The technicals broadly are positive, but if you look at something like the MACD, you're seeing a bit of divergence for these new highs. I mean, we're not really hitting levels that are clearly indicating strong bullish price action. It's still more of choppy to bullish. And I still think that's kind of where you will be through the election, maybe all the way to Thanksgiving. Now, it is fall. Summer's behind us. Oftentimes, that is a period where you do get a bit more volatility. And, we have the election coming up. So, it was a modest update. You had uranium up nicely today once again after a nice follow through or a nice breakout on Friday. You had some big moves. Lumen Technologies was up big. Trump Media and Technology down once again 17%, down to $7.10. Let's see. Oh, sorry, DJT. I think that was the warrants. The actual DJT was down 10% to $12 and change. And let's see, some big movers. Intel was up 3% on a potential buyout from Apollo or Qualcomm. Tesla was up 5%. That was probably the best mover of the big FANG names. But the bigger ones, Apple, NVIDIA, Microsoft, Google, they were plus or minus 1%. So not a whole lot of movement there as we head into the post Fed week, and overall it was just a modestly positive day.
Hi, I'm calling today about ticker symbol AGM, Rural Agricultural Mortgage Company. I was looking to get some financial exposure that's not necessarily banks, and thought this might be good. A little bit of agriculture exposure as well. Wondering if you thought this is pulled back, if it was a good price to get some shares. Thank you very much. Have a great day. Bye.
All right, looking at Federal Agricultural Mortgage Company, AGM is the symbol. And this is an interesting one. It's fairly small, only about $2 billion market cap, but earnings do continue to move higher, although earnings this year are supposed to be roughly flat year over year. And, maybe that's the issue with slower growth going forward. But, I like that it is this government entity, kind of like Fannie and Freddie, although you had some issues with Fannie and Freddie during the financial crisis, and that kind of swung them into, receivership. There we go. And there's still a battle in courts with that. Now, this one didn't have that crisis, but obviously could have that in the future. But it's, my issue really is it's moved up a lot. And the technicals are actually looking kind of weak over the past few months. It peaked out around $218 per share. Now we're down to $184. And it's been chopping sideways after that down move in August, early August. And that is kind of a bearish sign, to be honest with you. And that's something I would worry about a bit. Now, the fundamentals, they're pretty good. Return on equity about 14.5%. That is solid. It's right around the 5-year average. And historically, that's kind of where profitability has been. And once again, that's good. When you're in the mid-teens to higher in profitability and return on equity, that is a good place to be. But once again, I worry about that chart and why is it suddenly so weak? But the fundamentals are good. A lot of debt, but it's a lender, so that's what it typically does. It lends or has leverage, excuse me. And so I'm fine with the fundamentals, but I don't like the chart, and that's why I would hold off on it, keep it on the watch list, and wait for the technicals to firm up. Now, I hope you've been telling your friends about the InvestTalk podcast in video form over on our YouTube channel, and we get questions submitted over there via the comment section. And JG1 says, I want your opinion on Uber for a long-term hold. What is a good entry point? Well, Uber has grown throughout the years. They have their main competitor, which is Lyft. And their earnings are bouncing back. 2022, they lost a bunch of money. But this year is supposed to make $1.07 and $2.25 next year. But it's now a $75 stock, 74, 71 at the close today. No dividend here. And I think that's the issue is even if you go based on $2.25 next year, you're talking nearly a 40 times multiple, call it mid-30s, which is very, very high. So I just don't see the value in it. And I do think it's going to be very cyclical. They have leadership within the space, and that's certainly positive. But it's still a relatively low market cap, only about $5 billion. They have nice balance sheet, very little debt on the balance sheet. That's good. But once again, it's just too cyclical for my blood to pay this amount of multiple for earnings, especially because they continue to issue more and more shares each and every year and dilute the shareholders. So for now, I'm passing on Uber. Thanks for the call. Let's keep things moving and grab another question from 888-99 chart.
Hello, InvestTalk. I had another option question. It's like a theoretical question. Curious how this would work out where you buy a call option months out and expecting the price to go up. It seems like when you purchase options, there's only like a $5 price spread in the available options you can buy or sell. So for example, if it's $10, you might be able to buy an option at $15.5. And just say I buy an option months out and, my thesis is correct. The stock jumps up and it's now, $50 more. How do I actually close out a position? I was under the impression that someone would need to be on the other side of that trade, meaning they would need to, buy a option back from me at that same strike price. But if the price has gone up so much and the available prices are only like $5, spread between this much higher new stock price, like how could I eventually close out? And I guess my question is, would I be stuck with this super valuable call option, but not, able to cash out, essentially, would be my question and my worry. Hopefully that makes sense, but I'm curious to hear what you guys say on the podcast. And thanks as always.
Well, good question. And what you're actually talking about is open interest, meaning how many people are out there trying to trade that particular option contract. And when you're trying to close out an option or even open an option, that can be a worry, right? Because your spread might be larger than a lot of more liquid options. Because think about there are thousands of stocks that have option contracts on them, and there are hundreds of different option strikes, especially if you're looking at puts and calls with different expirations, etc. So naturally, some of those option strike prices and time expirations don't have a lot of interest in trading, just because there are other places for people to make their bets, and so that open interest can ebb and flow based on the size of the company and the amount of people that want to trade that particular name on the options market. So what you're talking about is a spread. When the open interest is very small, the spreads get very wide. Now, there's always going to be a market maker in there you're going to be able to exit with at least the value of the intrinsic value of the option, and then some, a little time value. So let's say it's $10 in the money. You're going to be able to sell that for at least $10 and probably a bit more. And there's a market maker there to help with that. But ultimately, what you're talking about is open interest. And that's why it is important when you're trading options to trade in options that have a lot of liquidity. Okay.
Hi, Justin and Luke. I was interested in investing in Avantis All Equity Market ETF. Symbol is AVGE. I just wanted to get your guys' opinion of it, if you think this is a good diversified way to invest some money in my Roth IRA. Thank you. Bye-bye.
All right, this is the Avantage All Equity Market ETF. It's more of a large cap value ETF, kind of dips into the mid cap space. What's interesting here is that it does have 30% of the portfolio in non-US stocks, so foreign markets. So you get a bit of exposure there. About 15% of this fund is in technology, 14% in industrials, about 18.5% in financial services, consumer cyclicals, about 14% there. So I like this mix better than the broad index, even though the expense ratio is about 23 basis points, not crazy higher than the broad index, but I definitely like the mix a lot better. And I'm going to give this one broadly a thumbs up. Financial health of the firms within it are good. Now, it is kind of a fund to fund. It owns a lot of other Avantis funds, but Avantis generally a pretty good fund family. So of the ETFs that are out there, this large cap value one is a thumbs up from me. Excuse me. Now let's pivot over to a focus point, and that is going to be about, where were we? There we go. Refinancing your mortgage. And a lot of people are going to start asking themselves, should they refinance or wait for a better deal? And mortgage rates have been trending lower in anticipation of the Fed rate cut. And you've seen over 100 basis point drop in the 10-year, which is a proxy for the mortgage rate. There's some spread there, usually about 200 basis points or so. It kind of fluctuates between 150 and 250 basis points above the 10-year Treasury. It's closer to that 250 basis points right now because we're at 3.7 on the 10-year, and your mortgage rates are hovering right around the 6% range. Now, a lot of that spread depends on what the Fed is doing, et cetera. They've been selling off mortgage-backed securities, and therefore spreads have widened a bit. So, refi applications have more than doubled over the last 7 weeks because of the drop in mortgage rates. And with rates just above that 6% mark, some 4.2 million borrowers are able to lower their rate by at least 0.75%. And that's the most since 2022, early 2022. And that means the average refi candidate could save about $300 a month. Now, does it make sense for you? Well, that depends on if you can recoup the upfront costs. Now, you may be able to cut more rate further if you wait, but maybe not as well, right? We talk about how the market prices in an easy policy. has already priced in fairly easy policy going forward. And if the economy surprises to the downside, well, yes, mortgage rates will probably fall a bit more because the 10-year will fall a bit more. If the opposite happens and the economy surprises a bit to the upside, well, that ultimately would make interest rates, make mortgage rates go up a little bit. Now, while refinancing activity is up, it's still down 75% since the boom of refinancing in the third quarter of 2020, when rates were at about 3%. Okay. Now, you should expect to spend between 2 and 6% of your loan's value in closing costs. So you need to calculate your break-even point of how long it's going to take you to recoup the cost of refinancing. And, is it over or under, say, 3 years, for example? And if you're planning to move away from your home over the break-even point time, then you probably don't want to refinance, right? Because you might as well. You're just going to move and you're going to sell that property and you're going to pay off the mortgage anyway. So that's a big factor. Are you locked into this home or not? And then do you have a fixed mortgage currently or an adjustable one? Obviously, if you have an adjustable one, a lot of people have, they bought a home with a 5-year, 7-year, 10-year arm. Maybe they're 3, 4, 5 years into it. And, that adjustment could come up fairly soon. And you don't want to be reliant on the Fed to continue to lower rates and those mortgage rates to get back down to 3, 4% because that's unlikely. Okay. Now, no matter what, you should always shop around, get at least 3 or more different quotes from different lenders. And also look for features of different loan offerings, like recasting your mortgage. A lot of times, the banks will know that, hey, you're going to refinance, and they want to get your business now, maybe at 6.5%. And say a year from now, they don't want you to refinance at 5.5% or 5% with somebody else. So oftentimes the average fee is around $200 to recast that, depending on the lender. So look for that feature as well and see what those costs might be. And those are kind of the nice the options that are out there. So once again, shop around. You need to calculate that break-even point, and you need to be very confident you are going to stay in that home well past that break-even point in the closing costs for you to actually go ahead with a refinance. Now, our 24/7 phone lines never close. You can call anytime. Leave your finance and investment question, 888-99-CHART. And here comes another listener question now.
Hi, Justin or Luke. I was calling to ask about ticker symbol NXST. That's Nexstar Media Group. Just wanted to get your take on the company and the sector, communication services. Wondering what you think about this company, how you think it'll do in this environment right now. Thank you very much. Have a good day. Bye.
All right, looking at Nexstar Media, NXST, and it's the largest television station owner operator in the United States with over 200 stations in 116 markets. So think of broadcast affiliates like Fox, CBS in your local region. Okay. And it has stations in 12 of the top 20 television markets. They reach 68% of US TV households. They also own News Nation, formerly WGN. They also have nationwide pay television network, and they own the CW, the 31% stake in the Food Network and Cooking Channel. So it's fairly well diversified. Now we do own this for some clients, but I will say is we actually sold it in one of our strategies because we just needed to make room for another position that we liked better. And so, it was on the lower end of the names that we do own, but we still own it for some accounts that were focused more on income because it does have a 4% dividend yield, which is good. It's taking its cash flow, which is really nice. It's buying back shares. It had 46 million shares outstanding pre-pandemic. Now it's down to 32 million. And one thing that's going to really benefit this company is the election cycle, because they sell advertising on these stations, these local stations. And especially think of people that tend to still watch NBC, ABC, CBS, all these affiliate networks. They do tend to be older. They skew older, and those tend to be people that vote. They tend to go out there and vote. And so the campaigns in the local markets and nationwide continue to spend big, and that's why they're supposed to earn $25 a share this year in earnings. Now, next year, earnings are supposed to set back to about $15 per share, but it's $165 stock. So still fairly healthy earnings, even though this year is a bit of an anomaly. Okay. But we like the company overall. Its chart is consolidating after the up move at the end of last year. So I like it, but obviously it depends on your priorities. And for us, in one of our strategies, we prioritize another name, while another, we prioritize the dividend that this continues to pay. Okay. Thanks for the call. Now I think we fit in another listener question now, so let's play it.
Hey guys, this is Art from Tucson, calling in today about a stock that I recently found out was publicly traded, and it's my gym, Planet Fitness. That's PLNT. Really provides a great facility and service, and there's a great number of these gyms all over the country. Seem to be very popular with young people and budget-oriented travelers that can use a gym pretty much anywhere they go. It's a great service, great facility, but I'm not sure if it's great stock. It does look like it's somewhat profitable. Might be a little expensive right now. Just wondering what you think about it, if it's worth investing in, and what a good price point would be. And I'll listen on the podcast to your answer. Thanks for all you do for us. Have a great day. Bye.
All right. Looking at Planet Fitness, and they're a franchise and operator of fitness centers throughout the United States, as well as Puerto Rico, Canada, Panama, Mexico, Australia, etc. So globally diversified. Still only about a $7 billion market cap, but pretty good balance sheet, pretty solid cash flows, about $185 million. But on a $7 billion market cap, what is that, a 2.25% free cash flow yield? Not that great, okay? Not that great. Now, what are they doing with shares outstanding? They are, it's kind of neutral. They've been buying back a little shares recently, but their amount of shares outstanding are fairly in line with where it was back in pre-pandemic levels. So they're not really issuing or buying back shares. Not a ton of debt, but solid cash flow. Return on invested capital, 8.5%. It's okay. It's not great, but it's okay. Enterprise value to EBITDA is around 19. And to me, that's just too expensive for this type of name. It is growing, but growth is slowing. Earnings are only supposed to be up 9% this year to $2.44 on an $82 stock. You know, you're playing 30 times for a gym. I just don't see it, to be honest with you. I think there are better options out there that you can utilize your capital for. Now, it might be a great gym to go to, and that might be a good place to start off at as an investment idea. But you know, digging in here with the valuation and the fundamentals, it just doesn't make sense to be buying Planet Fitness, especially after this run from the mid 50s all the way into the low 80s now, and it had a pretty decent reversal day today. It was down 2.7%. So I'm going to pass on Planet Fitness, PLNT. Let's go to Sammy in San Francisco with a live call looking at ARM Holdings.
Hey, Justin, thanks for taking my call. Wanted to ask you about your opinion on ARM Holding and if you have a recommendation right now to get into this stock at this price.
Well, ARM certainly has some great IP, right? A lot of semiconductor manufacturers, Apple, Qualcomm, for example, they built their processors on the ARM platform, and that's allowed ARM to extract a lot of royalties and build a business that is valued at $147 billion. Problem is that it's expensive. IPO'd last September. It's been moving higher ever since, and it's pretty expensive. Earnings next year is supposed to be $2.05. It's a $141 stock, 70 times forward-looking earnings. And, it's a business that historically is moves fast. And that means while right now their platform is the most energy efficient, it's easy for me to see the potential for other semiconductor companies to come up with an alternative platform. Think of, Intel trying to regain its footing. Are they able to build a platform, innovate a platform that can usurp ARM's dominance here? And so, are you willing to pay that level of multiples for something that is ripe for disruption? Now, it doesn't have to be disrupted this year, next year, or even the year after, right? But it's certainly an area that will continue to find or see innovation, and a lot of companies deploy CapEx. And so after this move, and the technicals, frankly, are weakening, to be honest with you, after the move down in July. So I would pass on ARM. It's just way, way too expensive for me to buy. Thanks for the call.
Hey, Justin and Luke, this is Rob calling with a question about gold, particularly GLD. Obviously very high right now and pretty overbought, but I wanted to see what your overall thoughts are in the next 6 months to a year. Do you see this continuing to rise? Do you expect more pullbacks in our current economic situation? Just curious about your thoughts. Thanks.
Well, I've been saying for a while, if you watch my YouTube videos every weekend, precious metals are very bullish. It just continues to march higher. Yeah, we're a bit overbought near term, but these 52-week highs tend to feed on themselves. And I've said that there's just swaths of investors, especially overseas, that continue to buy up gold. A lot of central banks. India is a big buyer of gold. And frankly, what's interesting is that not a lot of people are that excited about gold here in the US quite yet. So I still think there's a lot of dry powder. Still people focusing on Bitcoin, which has certainly been drastically underperforming gold as of late. And then gold is one of the best performers on the year. Now, GLD, it's a way to gain access to gold, but I would say IAU, which is basically the same thing, but it's put out by iShares, it actually has a lower expense ratio by about 15 basis points. And if you look at the performance, IAU outperforms by a little bit pretty much every single year. And so you definitely would rather buy an IAU over a GLD. But more broadly, precious metals just continue to shine, pun intended. And I would continue to allocate more and more money there on reasonable pullbacks. And, we could get one in the near term. GDX did have kind of a weak day today. Down 18 cents, not a big down day, but reversed throughout the day, which could portend to maybe some near-term softness in gold prices. But ultimately, I think you're going to continue to see a march higher in precious metals over the medium to long term. Now, let's talk a little bit about the office market. And offices have hit a 20.1% vacancy rate, according to Moody's. That's the highest they have ever tracked since 1979. That's when they started keeping track of the office delinquency rate. And in July, lending worth 8% of the value of mortgage securities backed by offices were delinquent. That's the highest since 2013. And a lot of these properties were financed during the heyday of very, very low interest rates. And a lot of them were bundled into securities. And many are now coming up for refinancing. And the big question is, can a lot of these get to a place where rates come down enough where it makes sense to refinance? Now, one thing a lot of people don't understand about the commercial real estate market is it's not like your residential real estate market where the loan to value is 80%. Okay. It's usually closer to 50%. That gives these banks and the lenders a lot of cushion, meaning the value of the properties can drop by roughly 50% and you don't lose any money, right? And so that is a big factor that is different than your traditional residential real estate market. Now, last year, a third of workers carried out some or all of their job from home. And that means, the demand for office space is down dramatically, especially in downtown areas. 32% of office space in San Francisco is now vacant. 23% in Austin is now vacant. And there are three groups that will potentially hold the bag here. Now, some of the big lenders would be insurance companies and private equity firms, as well as some in the debt markets. So that's number one, those kind of ones that hold the bonds. The second would be big banks, and their lenders most likely to be on the hook for these soured loans. And 4 times as many of their commercial bank loans have been delinquent for more than 30 days compared to those with banks with assets under 100 billion. So the bigger banks are certainly exposed, but the smaller banks, they have a bigger percentage of their balance sheet there, and they're the ones that could get hit. But a lot of those, they have the strip malls, which aren't nearly in trouble as the big high rises in the center of big cities. And so, the moral story is things are getting worse in that space, but it's not to the level that we will see some sort of giant risk to the financial system. It's just a problem pocket of the lending market and not something to get all up in arms about. Okay? Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good day.
Here's a quick reminder. The newest InvestTalk Wealth webinar is happening soon. Tuesday, October 8th at 11 a.m. Pacific Time. The InvestTalk Wealth webinar will focus on effective strategies for managing your 401k and enhancing your retirement savings. Go to investtalk.com and sign up for our upcoming Wealth webinar, October 8th. It's free to attend, but you must pre-register. And please tell your friends.